Good evening and welcome to tonight's live webinar. It's member-only content, ASX Investment Opportunities in Review for the 8th of March. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. The Investor Signals model portfolios updated as of the end of February. The returns continue to outperform their benchmarks. The Australian portfolios underperformed slightly over the last 6 months, but as you can see there from the 3-year and 5-year average, it's outperformed. My explanation for the underperformance just over the last 6 months has been the models have been slightly overweight some of the gold exposure, a little bit underweight Aussie banks, and that's really made the difference over the short term. But as you can see over, as I mentioned, the 3 and 5-year periods certainly outperforming the index. In the US, continued to do well, even on a short-term basis, outperformed the market over the last 6 months by a substantial margin in the US, and again the 3-year and 5-year average doing better than the S&P index. So if you'd like to know more about the model portfolios, please give me a call at 1300 614 002. We operate the broking account service inside Interactive Broker, where we can provide you access to the model portfolios as well as an independent portfolio and derivatives to enhance the returns. The technology that we're using tonight is the Investor Signals member area. You can subscribe to it for $1,320 for the year. For more information on the products and services, visit our website. The Nasdaq graph up on screen. So we've been watching this for a number of months coming into the end of last year, and obviously we've seen the shift that we've been looking for here, which was a breakdown in the high PE valuation stocks. And we'll have a look at Tesla chart shortly and use that as the poster child for high PEs. In the case of the Nasdaq, we're now seeing a correction from approximately 14,000 points down to less than, sort of rallied back up on Friday night, but the futures are down at the moment, so it looks like the Nasdaq's going to be trading around 12,500 or thereabouts this evening. And there we have a look at the Nasdaq when we think about it from a long-term perspective. So the 2000 bubble and the PE correction bubble that is in the early stages of bursting at the moment, and the implications that that has when you're thinking about which stocks to include in your portfolio. So moving into a graph of the XJO, and then I'll have a look at the Nasdaq. But just whilst we got the XJO here, so we can see our markets ran into resistance at about 6,900 points, came back down, rallied back above the average, pulled back below, rallied back above it today, but closed below the 10-day average. And the 10-day just gives a bit of a reference point, especially when a downtrend is getting underway, or conversely, if a new uptrend, we'll start to use this as a little bit of a reference point, just to sort of filter out some of the noise of the market. We can clearly start to see the momentum's rolling over, and the first level of resistance there on the way back up, it'll be roughly 6,860. But for the moment, whilst the market is below the average and below that resistance, we remain a little bit cautious. Having a look at the Nasdaq, and this is where you really see sort of those high PEs starting to correct. We've had that move from 14,160 down to the lows prior to Friday night's rally, where the Nasdaq was trading around 12,400 points. So for the most part, it stayed below the average there, rallied, sold off, rallied back up, tested the average, and then sold off again. Push back up towards that average, and weakness suggested in tonight's open in the US. In the S&P 500, the pattern's similar. We've seen for the most part, it closed below that moving average, a little bit stronger, which the explanation for that has been part of this rotation trade out of technology into companies that benefit from an opening economy, so travel, tourism, industrial companies that have energy, banking have been areas that have performed well. So therefore, in percentage terms, the S&P hasn't had that same level of sell-off that the Nasdaq has. The risk for the market is that it moves from a high PE correction, which is all it is at the moment, into something that's more of a concern around earnings and overall PEs relative to treasury yields. At the moment, for the most part, industrial companies, banks, energy, etc., not being impacted by the rising bond yields, or not being negatively impacted by the rising bond yields. Where that's been felt the most is the high PE technology area of the market. Tonight I was going to go through the list, but given just a few different random lists being watch lists, the ASX signals, but I encourage you to take a look at those in your own time. And given the moves in the market, we'll stay focused on the top 100 tonight. So I get the percentage gainers to the top. We organise it in buy signals first. So as we move through this, we'll be looking at all the stocks that are in the top 100 model portfolio, and then we're going to get switched from stocks that are under buy conditions into sell conditions, and I'll just share with you my thoughts on which ones of those you might want to keep an eye out for counter trend trades. But TPG, we continue to like this, but recognise that the earnings result wasn't particularly inspiring. As the company provides more clarity on dividend payout, we might see a little more upside there in TPG. Oil's been strong. Beach has done well. We've highlighted the opportunity in Beach off this $1.50 support. It's above the moving average. Both Beach and Woodside Petroleum we continue to like. Computershare benefiting from higher interest rates and the added activity in the housing market. $13 support there off the algorithm buy signal, and it's rallied from 13 up to 15 at the moment. IDP Education's under buy signals from back here at around $14. Newcrest Mining, so it's starting to see a little bit of buying in gold just over the end of Friday's session, and some interest in the gold stocks this morning on the ASX. Whether gold can rally as well as the 10-year Treasury, we'll wait and see. I think that the approach here is that gold is probably closer to a bottom than it is, a further sell-off. So you want to be watching these gold names closely. We still like Newcrest, Northern Star, Gold Road Resources. We still think there's, maybe the ETFs, which is GDX and miners. There's still room for exposure to gold in the portfolio, and I'd be surprised if we get 2 or 3 months down the track and don't look back and sort of recognise that this was a good buying opportunity for the gold stocks. Aristocrat Leisure under algorithm buy signals, support there at around that, just sub $30. Appen Group, maybe in the early stages of the beginning of a rally. So if you're looking, obviously there's a higher risk proposition with this trade given the earnings downgrade, and it is one of these high PE tech names, but the stock price has corrected from $45 down to $16 at the moment. I've only seen confirmation out of the company that earnings are down around 30%, so watch for a move back above the moving average, and if you're looking for a trade, that could be something that makes the list for you, and just run a stop loss below that recent $15 low, or a break below the moving average. You would get stopped out. But give it a chance to rally by letting it track above the average. Aurora, we like this from a fundamental standpoint. The earnings turnaround has been impressive in the latest result, and the company's buying back their own shares, which underpins the share price a little. Amcor, we like this. This is an overweight position in the portfolio. I've been talking about this on the blog. Really has the potential to trade up at around 15.50 without too much of a stretch there. Altium, good quality tech business, but it is on a high PE, has corrected substantially from 40 back down around 25, a little like Appen. Wait for it to cross above the moving average and then stick with it as long as the momentum carries the price action higher above the average. Soul Pattinson not doing there at the moment, but is under algorithm buy conditions, as is Evolution. Illumina under buy conditions, and I've posted this on the blog. We see support there at around that 160 level, pushing above the moving average, so certainly one to think about. Charter Hall, our preference for the most part is the SLF ETF, which is a property ETF. The other alternative to that is the MVA, which is a basket trade to the REIT sector in Australia. At an individual name level, we like Goodman Group. But Charter Hall now under algorithm buy signals support there at around that $11 to $12 range. Link Administration under buy signals. JB Hi-Fi corrected from 55 back to 42 under buy signals now. ASX, we like this and we have this as an overweight position in our portfolio at the moment. The stock's gone ex-dividend on Thursday last week. It's recovered that and more. Flat earnings, but attractive dividend yield at 3.5% fully franked. Domino Pizza's corrected from about 118 now down to around $87. So I've put in support there at maybe $80, but I'd expect it to consolidate down near that level. It is a high quality business with good growth prospects. Suncorp Group under algorithm buy signals there, and you can see the support indicated on chart, but that's switched from buy conditions. Just jumping back to Suncorp, just to be clear, it switched from sell conditions up here into buy conditions now at around this 960 support level. Commonwealth Banks switched from sell conditions into buy conditions. It's out of the four major banks, it's the only one in the model portfolio at the moment, and it's rallied from around that $82 entry level now up to $87. Star Entertainment under algorithm buy conditions there, supported around that $3.40. Hard to get too much visibility on their earnings at the moment, but the market's willing to be patient and reward Star for what the market perceives as certainty of earnings growth over the next 12 to 24 months as tourism recommences. Woodside Petroleum, this is one that should be sitting in your portfolio at the moment. It's switched to algorithm buy conditions there at around 23, now pushing up 25.5. ALS, we're not doing too much here in individual portfolios, but it is now a holding in the top 100 models. So it's switched from sell conditions into buy conditions, and the entry there was around that $9.15 level. AusNet Services now under algorithm buy conditions, support around that 165. APA, I like this from a fundamental standpoint. I see earnings recovering and returning back to mid-single digit earnings growth over the next 12-24 months. Should support a rally back to around 10.50 at least in APA. Woolworths, we've seen the market turn a little bit negative both on Woolworths and Coles on the expectation of a slowdown from the record earnings growth that were delivered in the most recent results. Woolworths delivered about 14% earnings growth. Coles was a little less. I think Coles came in around 7%. In the case of Woolworths, the added benefit to think about here is the upcoming spin-off of the Endeavour Drinks and Hotel Group, which will help to unlock about $10 billion worth of value for shareholders in that they'll end up with either shares in an independent listed business or maybe a full trade sale and a capital return to Woolworths shareholders there. But supporting Woolworths at around $39, I think that's attractive, and if you're really trying to drive extra income, sell a covered call over it. Fortescue Metals, iron ore still remains well supported, so we're still comfortable with Fortescue as our preferred resource exposure. Seek, we like Seek, but it is expensive. So if we get this ongoing sell-off in the Nasdaq, I'd expect Seek to maybe come back down and test as low as $23, and you'd want to add that to your watch list at that point in time. The XTO, which is similar to the XJO. ResMed, support down here at around there. You can see a sort of on weakness, maybe back down to 22. But it had been delivering very good earnings growth, including its last earnings result. So we've seen a correction from a PE standpoint from $30 back down to around 24. It is on low yield, but is delivering double-digit earnings growth, so expect ResMed to find buying support. Cochlear, we hold this in the model portfolio. and again, a little like ResMed, it is expensive, but it will benefit from better access to elective procedures, and we'd expect Cochlear to have limited downside. Atlas Arteria support that around just around that $5 level. Coles, we like this. There's a value play here. If we do see another leg down into that range there, sub $15, I'd shift Coles to a high conviction, even in light of the earnings slowing down. We think sort of 4 to 5% earnings growth, 3.5% dividend yield, fully franked, makes Coles attractive again. Cleanaway, likely to deliver mid-single digit earnings growth, so somewhere around that 3 to 5% mark. There is a fairly substantial acquisition that Cleanaway's looking at, which I think in the value of around $3 billion, taking up a major competitor in the Australian waste management industry, and we'll start to monitor a bit more closely what the likely outcome of that is. We've seen Cleanaway have a change of CEO, and I think that's a good thing for the business. So we'd be looking for some more substantial growth initiatives coming from the new CEO, and part of that may be finalisation of this acquisition that's on the cards at the moment. Downer EDI, we like this. A company delivered good earnings growth, record development pipeline, 70% of revenue supported by government contracts, exiting and winding down some of their mining services side of it, potential to return capital to shareholders from the sale of those businesses or business segments. So I'd be surprised to see it back below that 480, 490 level, but should continue to trade higher over the next 12 to 24 months. Mirvac now under buy conditions, GPT under buy. Goodman Group, you can see there the range. So if we do see a softer market and a retest sub $16 in Goodman Group, I think there's a really strong case, even in an environment where interest rates are rising. We feel that the double-digit earnings growth in Goodman Group and that their development pipeline has doubled in the last 12 months sets the business up for a pretty good period over the next sort of 1 to 3 years. Obviously, the rates may weigh on sentiment short term, but if we don't see those rates spiking too much higher, then it should set up a good background for Goodman Group to find support on this sell-off and then rally higher later in the year. Lendlease Group, we like this. The long-term story, there's good short-term issues for the business are obviously substantial. Wesfarmers, buy this on the dip, maybe a retest just below that 49, so getting back down to say 47 or $49 should provide a good support level in a soft market. Xero, we like this within sort of the high PE growth areas of the market. Xero's just made a substantial acquisition in Europe, which will help to expand their accounting distribution product into Europe, or create a customer base for them to offer their product to. So deep discount is obviously back down at around $90. Not really expecting to get down and test that in a soft market. If the Nasdaq remains under pressure below that average, we could see a retest of sort of 107, 108 thereabouts. But we do think ultimately you want to be a buyer of Xero on this sell-off. REA Group looks a little expensive for us. It is under algorithm buy signals, but the original entry was back at 106. Fair value for REA really appears to be back more like around 120, so less excited about REA. Northern Star, with the merger with Saracen, we think this should be a beneficiary of a recovery in gold prices, so it's one of our preferred ways to leverage the exposure there to the recovery to gold. Sonic Healthcare, when we run the numbers on Sonic Healthcare, even if you strip out the added revenue boost from the COVID testing that the company's generated, the underlying business is still growing at about 5% per annum, still delivering 3.5% dividend yield. So at around $30 to $31, Sonic should find support, and you want to be a buyer of that. Transurban, obviously traffic numbers are a little bit slower to pick back up to levels where we came from pre-COVID, so that's likely to continue to weigh on the recovery there for Transurban. But it is high quality infrastructure play that that we are happy to hold in portfolios. Cube Holdings, I like this business. I put a post on the blog sort of saying just be patient, wait for an opportunity sub 275. Back at 275, and that's the entry level that you want to look at on a 2 to 3 year outlook. The container volumes are up substantially both in December and January. Haven't seen the February data yet, but I think December from memory was up about 7%. February was up even more, maybe something like 12% in February on the same time last year. So any weakness over the coming months in Cube, I'd see that as a buying opportunity. Car sales, so support there at around that $18 level. Less likely to see it retest that bottom range there at 16. I think maybe something just sub that $18 level, you want to be a buyer of it. So with all these names that are under selling pressure at the moment, especially in this area where they technology, high PE, not in the same order of of Tesla or some of the chip stocks in the US, but nevertheless, when you're paying sort of between 25 and 45 times earnings, you may just want to be a little bit patient on the entry level and wait for it to cross above the moving average as confirmation that the buying support's starting to come in. But car sales and Zero are probably the two technology plays that I are leaning towards over, say REA or Seek as the other alternative. So car sales and Zero are the ones that I like. CSL, buy this on the dip, so retesting that prior low there at around that 240. Be a buyer of that. So A2 Milk, this could be a recovery play opportunity for 2021. Sydney Airports, less excited about that. I think APA and maybe Transurban are the two that I like within the infrastructure space. BlueScope Steel switched to algorithm buy signals there at around $16 now, pushing up towards 18. WiseTech support back at 25, but not doing too much there. Qantas, it is in the model, but hard to get excited about that. Likewise with Stocklands, it is under buy conditions, but we're not doing too much there at the moment. Next DC, not fond of this business, concerned around their accounting, and we're just staying away from that. Fisher Paykel, so I think you want to add this to your list. It is a high PE. It was trading up at around 50 times earnings at $35. It's now corrected down to $25. It may be a case where the market is simply just selling anything that's on a high PE. Healthcare's been under pressure, but this is a terrific growth business, growing earnings at about 25%. So if we create the range and say, well, maybe between 22.50 and 25.50, within that range, you'd expect it to find buying support. I think it would be getting oversold if we saw it down at that 22, 23 level, and the stock really has the potential to rally from say $22, $23 back up to $30 to $32 comfortably. I think when the earnings picture continues to come through over the next 6 or 12 months, it'll continue to drive Fisher and Paykel higher. Afterpay, we're concerned on this from a valuation standpoint. The correction's underway. This is a classic example of where the company is trading on 30 odd times revenue, not 30 times profit, but 30 times revenue. The company really needs to increase its existing revenue by, so the business needs to grow fourfold just to sort of fit into a reasonable valuation, and even what a number of analysts consider a reasonable valuation is $30 a share. So the stock is too expensive, and we're seeing the correction. I think just as Tesla's probably one of the poster childs in the US of high PE corrections, Afterpay would be one that I would draw parallels with here in Australia. Obviously different industries, but just purely from the type of investors that are chasing these stocks or have been chasing these stocks higher in valuation. So now seen a correction from 160 down to 111. 50% of this wave would be sort of the first point that you might start to think about taking a look at it. But for us, there's just better opportunities from a risk reward standpoint in the market. Treasury wine, so now we've gone from stocks that are under buy conditions into stocks that are under sell. There's speculation that Treasury could be private equity could be looking at a takeover bid at Treasury wines. Now that hasn't been substantiated. The speculation is the takeover price is at around $16, but the stock really didn't close up on the high, so I don't know you can draw too much certainty from that, but we'll continue to monitor that story. Oil Search is doing well. Preference though is Beach and Woodside over Oil Search. Macquarie, it was only a number of months ago the market was expecting 20% fall in earnings from Macquarie. It came in at -8%, and I think we're heading back to a point where earnings are going to be sort of flat on, say, the same time where they were in, say, 2019. And that does support the valuation up at these levels, so less negative on Macquarie than what we had been. Rio, preference really Fortescue, but still like BHP, Rio, Fortescue. I don't think there's enough evidence that iron ore and energy prices and metal prices in general are moving lower, but we keep an eye on that as we watch the US market. Incitec Pivot, we like that, but the recovery pretty much is complete there. BHP, again, comfortable holding that. BHP, Rio, Fortescue. Spark Infrastructure, under sell conditions, not doing it there. Origin Energy, maybe think about this as a turnaround play. As long as it trades above the average, you could look for a short-term trade and momentum trade that higher. Boral, we're not doing there at the moment. AMP, not doing there. Worley's, will skip through that. Challenger, cautious there. Medibank, limited earnings growth for Medibank. Orica, could be a recovery play, but maybe better opportunities in the market. Telstra, we like coming into the finalisation of the bids for TowerCo. Bendigo, still cautious on the regionals. Ansell, happy to take a look at this. If we saw a little bit more downside selling in there, I think there's an argument that Ansell's getting back to a level where a counter trend trade could be considered. IGO not doing there at the moment. South 32, the recovery really for us is complete there for the moment in South 32. Nine Entertainment, a bit cautious there. That's one to think about on the short side. Oz Minerals, mindful that some of the research suggests that copper goes from deficit into surplus supply in the back half of this year. So we look for a correction in Oz Minerals and then a buy on the dip. Dexus not doing there. James Hardie, wait for a pullback and a switch to buy conditions. NAB, we wait for a pullback and a switch to buy conditions. Likewise with Bank of Queensland. Brambles, happy holding this even though it's under algorithm buy signals. We think the 5% earnings growth, just under 3% dividend yield makes it fairly attractive and a low risk proposition. Coca-Cola, likely to proceed with the $13.50 odd bid from the European parent. Mineral Resources, so look for a correction lower here and a switch to buy signals in the coming months, and I'll draw your attention to that during the webinars and on the blog. Insurance Australia Group, potential recovery play, may take 6 to 12 months to really play out, but probably down to a level where it's reasonable value, so we'll continue to monitor that, but not doing it there at the moment. Horizon Holdings, avoiding that. You can see it's under sell signal, made the lower lows, lower highs. QB Insurance, now under sell conditions, so you see the sell signal there. We've removed that from the models. Centre Group, under sell signal, not doing there. ANZ up against resistance there at around that $28, $29. We think the Aussie banks have probably rallied a little bit too far at the moment. Likewise with Westpac. CBA, we're comfortable holding the best quality Bank Ampol getting back down to a level where a counter trend trade might take place. Tabcorp up against resistance and look to sell that. Magellan, wait for it to cross back above the average, but if there was a bounce higher in the US market, Magellan's one to think about, but I don't think that's where we're sitting at the moment. AGL under pressure and has been moving lower off the algorithm signal. Crown under resistance at around $10. Ramsay Healthcare under sell signal there. Don't think the downside risks are too substantial though in Ramsay. Reliance under sell signal. Vicinity under sell. Santos under sell, and there we are back to TPG. So just to finish with a couple of these ETFs, earlier in the webinar I mentioned the SLF, which is the property ETF. So this is just an alternative, so being mindful that Stocklands, well, if we have a look at the ones that are under algorithm buy signals, we go into the top 100, and if we just skim through some of these and have a look at the so we've got Charter Hall under buy. We've got Goodman Group, GPT, Lendlease, Mirvac, Stocklands. So we have a few of the property stocks under buy signals. So an alternative to holding too many of those in your portfolio is just to think about this, the SLF, which is the Spider ASX 200 property fund. The other alternative is the MVA, which is the market vector. Van Eyck vector.